Hey guys, welcome back to the channel. This is Shrish here from Trading Explained, and in today's video we are going to talk about top 5 trading problem for beginners. We will be going in descending order, meaning from 5 to 1, on the scale of which 5 will be the least and 1 will be the most troubling problem for all. I have also provided timestamps below, so if you want to skip to a particular problem, you can just do that directly, but I encourage you to watch the full video so you get the context of what I am trying to say in the video. So without any further delay, let's begin. So the number 5 on our list makes up this problem. Which markets should you really choose from? Now when a beginner starts trading, he gets a lot of confusion to understand which market should he really be trading in. There's cash market, derivative, FNO, currency, cryptocurrency, commodities, whatnot. There are so many options, and that is why it makes up for the confusion, right? But there's this paradox too. When we get so many options to choose from, we really likely to get confused to what we should really be choosing. And the same thing happens over here. When a beginner starts trading, he gets so many options to choose like that he gets confused to what he should be really trading in. The answer to this question is pretty simple. If you are a beginner, start off with cash market, forget everything, forget commodities, cryptocurrencies, all of this, just forget all these things and start off with cash market. Cash market is basically stock market on which the stocks are listed, and other markets are like the commodities and the derivatives market. In these market, you have to trade the FNO, the futures and options thing, like the lot sizes and everything kicks in, and that takes up the risk significantly higher. So to avoid all these things, just forget about all these markets, start off with the normal cash market, normal stock market. Don't even trade FNOs of stock market, just basic stocks, Apple or Google or whatever those are. Just start off with the cash market and then start off with the quantities. Like don't jump to 1000 or 2000 quantities just right away. Start with 1, 5 or 10 quantities and then test how you're doing. If you're doing good, you can increase the quantities whenever you want to, but just don't start off directly with 1000, 2000 or 10,000 quantities. So start off with the cash market, ignore all these other markets, start off with the cash market and start with lower quantities. So now this question is clear. Which market should you really trade in? If you are a beginner, start off with cash market, followed by then you can trade currencies and commodities, and the last market you should be touching is the cryptocurrency market, because cryptocurrency is so volatile. The market is so volatile, it goes up 10 to 15% in a day or two, and that's pretty volatile. That's crazy. It can literally blow your account in a day or two. So just if you don't go there, that will be the best thing for you. But if you want to trade it anyways, just take the experience of all these markets first and then choose to try out cryptocurrency thing. So first of all, if you're a beginner, just try out cash market, ignore everything else. Once you start understanding cash market, once you start getting a grip of what cash market is, you can then jump to commodities, currencies and all these things. And once you get experienced of these markets, once you get experience of volatilities of these different markets, then maybe you can try out cryptocurrencies. Just don't start off with cryptocurrencies, you will be in a big danger. Let's go on to next problem now, and the number 4 problem that makes up to our list is price action versus indicators. Now new traders, the beginner traders, get confused between what they should be using to understand charts. Like once you have understood which markets to trade, now the question comes what you should be using to understand the charts. Is it only price action that's going to help you, or should you be using any indicators too? Are they any helpful, or they are going to help you? Like these questions arise a lot, and now this is where it gets a bit tricky, because you can rely only on price action. For those who don't know what price action is basically only understanding the charts based on what the candle patterns are saying, without any help of other indicators or else. So now this question is, price action is fine enough, but you have to understand it deeply to really understand markets based on only price action. Like when you have mastered the market after trading 4, 5 or 6 years, at that point you can understand price action at a whole new level. But like right now, what you have learned, just the basic candles and everything, it won't give you a complete understanding of what is happening in the markets, and that is why I won't encourage you to try out only price action if you are a new beginner trader. If you're a new trader, if you're a beginner trader, you have to use indicators, at least some of them. I personally don't like using indicators that a lot, but I had to use them too. Like when I was new to the markets, to the trading thing, I did not understand a thing. And to understand basic stuff of what really is happening in the market, what the chart is trying to say, you can take help of the indicators. They're not bad, but once you progress ahead, like when you have spent a significant time in the markets, you can just remove them out because the price action gives you a better idea overall. So until then, if you are new, you can take help of indicators. Now what indicators you can use? You can use RSI, MACD, VWAP. These are some basic good indicators that are there. You can use pivot points. There are thousands of indicators out there, but don't try out each and everything. Just moving average, MACD, RSI, VWAP, these are the basic things that people have been using since years and years, and they have been using it because these things work. So you can use these things. You can try out others as well, but you will have to study on yourself for all these things. So let's now go to our next problem. The number 3 problem that makes up to our list is stop loss hunting. Now once you have understood what markets to trade, once you have understood how to understand a chart, the next problem that really comes into picture is stop loss hunting, because when you start trading, there's this stop loss hunting going on all around. The moment you start trading, your stop losses get hunt, and then you're frustrated that this thing does not work. So to understand stop loss hunting in absolute detail, I have made one video on stop loss hunting dedicatedly. You can watch, go ahead and watch that. I will put the link down in the description and in the I box. You can check out the video from there. But to give you a basic understanding from how to save yourself from stop loss hunting, the number one thing you can do is keep those stop losses mental. You don't have to keep physical stop losses. Keep those stop losses mental. Don't put directly in the system. Now this is absolutely risky if you do not follow the rules, right? What is the rule? If it's not a stop loss hunting, this is the number 1 rule. If it's not the stop loss hunting, you have to get out, because you don't have any stop loss in the system. Until you exit manually, the market is not going to exit you out. It will keep extending your losses further. So the number 1 rule is, if the moment you understand this is not stop loss hunting, you have to get out manually. All right. So how do you understand what is a stop loss hunting and what is not? Okay, let's take an example. There's this stock XYZ trading at 100 rupees and you buy at 100. What happens? You keep stop loss at, let's say, 99. The market comes 99, 98.5 or so maybe, and then bounces back to 102 or 103 levels. Now you will say that, okay, I knew the market is going to go to 102 or 103 levels, but it took my stop loss first and then went ahead. And this happens a lot of time in the market. So to do that, what you can do is you keep your stop losses at a support or resistance level, right? Like when you sell market, you keep your stop loss above the resistance level, and when you buy the market, you keep your stop loss below some support level or so. So what you can do is you can keep those stop losses mental, and see if the market is trying to hunt your stop loss or it's actually trying to go down. If it's trying to hunt your stop loss, it will give a quick move from that support, which means from 100 it will go to 99 or 98 something where the support level is, and from there it will bounce back immediately, like quickly. It will just break that support for a moment, for a brief moment of time, and then bounce back quickly up again. So this explains us, and it forms a wick. It clearly forms a wick of a candle. So when a wick is formed and such quick recoveries do happen in the market, that tell us that this was a stop loss hunting. This was not the market trying to go against you. So when this such quick recoveries come, you can just hold on to the market without exiting, without panicking. And if the market shows the sustenance of price or under the support level for a moment or so, like from 100 it comes down to 99 and 99 is the support, let's say 99 is the support, it shows sustenance for a moment, like it sustains 99 or 98.9 for a while, then you have to understand that this is not hunting, because it's not recovering back immediately, which means this is not stop loss hunting. This might actually start going against you. So when there's this quick recovery comes, you understand that this is stop loss hunting. And when the quick recovery is not there, it shows sustenance for a while, which means this is not stop loss hunting, and this is the time which you have to get out. Because if it shows sustenance over there and if you do not exit, the market will keep extending your losses further ahead. So let's move out to the next problem. The number 2 problem that makes up to our list is, what exactly is risk management? Now most people know risk management, they have been understanding and talking about risk management. Like most of you do understand that what risk management is, like risk 1% of your capital and all those things. We have been hearing about all these things ever since we get into this finance thing. But does all these things really work? Like 1% of the capital, when you do not even have the capital, does that make sense? Like just imagine if you have 1 lakh only, and in that 1 lakh, if you start risking only 1% of your capital, it's not going to help you anytime soon. So what you can really do is, the measure of risk management should not be really in terms of percentage when you start out. It really should be what number makes you panic. Like doesn't matter what capital you are having, but what number makes you panic. Like if it goes minus 600, minus 700 and now you are panicking, then despite whatever capital it is, the panic thing, that should be your risk management number. So when you start panicking, you have to exit. The moment you start getting feared about your losses, the moment you start panicking, you have to take an exit. So that is the basic principle of understanding what the risk management is. Because once you start panicking, which means you are not comfortable holding that position, and because you're not comfortable holding that position, it will make you more panic as the market starts going against start to go against you. And the number one problem that makes up to our list is the fear of execution. Now this is the biggest problem most people have when it comes to trading. Even the professionals do face this issues when sometimes they are trading, the fear of execution. And there is absolutely nothing one can do about this problem except for practicing, showing up every day. No matter whether you're making money or losing money, most of the time you're going to lose money, but does not matter. You have to keep showing up every day until you get a habit of trading. Now this is very important, because until you have a practice of, until we have practice of anything, everything feels uncomfortable. So you need to get a habit of trading and putting out your trade plan practically into the market. Showing up every day is probably the only thing you can do, because there's nothing much we can do about this fear of execution, right? We all have it from birth. We all love our money and we all hate losing it. So that is why the fear is absolutely natural and we cannot do anything about it. So all we can do is just practice execution, practice executing your trade plan over the long term and make a habit of it. So that will not help you eliminate the fear, because it's not going anywhere. But all you can do is control it. You can learn to control it. You can learn to minimize it over the long term, and maybe that will help. So these were the top 5 problems for trading for beginners that bothers beginners a lot, and these were my answers to it. So if you like the video, make sure to subscribe to the channel and give the video a thumbs up. Comment down below your thoughts and let me know what you think about the video, and make sure to subscribe to the channel. I will see you in the next one. See you around. Peace.